Hey everyone, Randall here from Tax Samaritan. Many Americans buy homes abroad for a new life, a rental, or an investment. That dream feels great until U.S. taxes enter the picture. Today I'll break down the rules in simple steps so you avoid surprise taxes or IRS penalties. The U.S. taxes you based on citizenship or residency, not where you live. So when you own foreign property, the U.S. still wants details about your income, your accounts, and sometimes your company structure. Don't worry. Once you learn the basics, you'll stay safe. Let me share a quick story. Sarah moved from Texas to Spain. She bought a small apartment and rented it while she worked in Madrid. She kept the rent in a Spanish bank account and never moved the money back to the U.S. She felt everything stayed over there, so nothing touched the U.S. But the IRS tracked her account balance. It jumped above $10,000 during the year. That triggered FBAR reporting. She also earned rental income on her U.S. property, so she needed to report that on Schedule E. Sarah learned this the hard way, unfortunately with penalties. You don't want that. Here's the good news. Buying a foreign home alone doesn't trigger U.S. tax. The IRS doesn't tax the purchase, but once you open foreign accounts, rent the home, or later sell it, the rules change fast. When you open a foreign bank account to pay the mortgage or collect rent, track the balance. If the account balance of your foreign accounts in the aggregate climbs above $10,000 at any point, you must file an FBAR. If your total foreign assets jump over $200,000 while you live abroad, you may also need to file FATCA Form 8938. These forms trigger penalties when you skip them, so take them seriously. Many U.S. banks don't lend for foreign homes, so most buyers pay cash or borrow from a foreign bank. You can deduct mortgage interest, but you must convert every amount into U.S. dollars using the correct exchange rate. When you earn rent from a foreign property, the IRS wants you to report every dollar on your U.S. tax return. You list it on Schedule E, even when you keep the money abroad. The rules follow 3 simple paths. Number 1, if you rent fewer than 15 days, you can skip reporting, but you also skip deductions. Number 2, if you rent at least 15 days and use it personally fewer than 14 days, you treat it as a rental. You report income and deduct expenses like repairs, utilities, and mortgage interest. And number 3, if you rent a lot and use it a lot, you split the expenses between personal and rental use. You can lower your tax bill with deductions for mortgage interest, insurance, repairs, management fees, utilities, travel for rental work, etc. But foreign property taxes unfortunately don't qualify as deductions anymore, and you must use a 30-year depreciation schedule. If the foreign country taxes your rent, you can claim a foreign tax credit on Form 1116. This credit often wipes out your U.S. tax on that same income. When you sell, the U.S. treats the sale the same way as a sale in the U.S. If you earn a profit, you may owe capital gains tax. If the home served as your main home for 2 out of the last 5 years, you may qualify for the $250,000 home sale exclusion. Foreign tax paid on the sale, you may use the foreign tax credit again. You may need extra forms when you hold property through a foreign company, partnership, or trust. Common in countries like Mexico or Thailand. If you hold it through a foreign corporation, it's likely you'll need Form 5471. If you hold it in a foreign partnership, you may need Form 8865. If you hold it in a foreign trust, you may need Forms 3520 and or 3520A. These forms bring heavy penalties if you fail to file them, so don't guess. Click the link below, book your free 30-minute call, and let's get started.